Hi everybody, and welcome back to video number 6 in chapter 19. And when we left off, we were looking at reporting pension plans and financial statements. And here for net income, 1, we're going to show pension expense that includes multiple components. That's going to include the service cost, interest cost, return on assets, and amortization. And number 2, the FASB requires presentation of the components of the pension expense as follows. The first one is service cost component is reported as pension expense in income from operations. And the second one is other components of pension expense are generally reported as one net amount in the other expenses and losses section below income from operations. And if we look at that for the Zarro Company, here's an illustration. We have our sales revenue, cost of goods sold, gross profit. But here below the gross profit line, we show the pension expense, the service cost of $16,000. And then in other expenses and losses, we show pension expense, other components, of $28,312. This, of course, is for the year ended 2028. All right, comprehensive income. Companies, 1, are required to recognize actuarial gains and losses and prior service costs that originate in the current period in other comprehensive income. And number 2, actuarial gains and losses not recognized as part of pension expense. Okay. And number 3, the board requires that the prior service cost arising in the year of the amendment must be recognized by an offsetting debit to other comprehensive income. Let's take a look at an illustration. Here, the Zarro Company's 2028 worksheet is used. It indicates that both the prior service cost of $17,600 and actuarial gains of $6,212, you'll remember that's the $6,040 plus the $172 that were amortized. And those are amortized to pension expense in 2028. The increase in other comprehensive income is computed as follows. So our prior service cost amortization, $17,600. The gains and losses amortization of $6,212 gives us a combined other comprehensive income of $23,812. Now, the computation of comprehensive income for 2028 is going to be, we'll start with our net income of $345,688, and we'll add other comprehensive income that we just calculated here, and that gives us comprehensive income of $369,500. So, if we take a look at an illustration, here's our net income, here's our other comprehensive loss, we have the actuarial liability loss of $6,212, and the prior service cost of $17,600, giving us a total of $23,812, which we added to the net income to arrive at comprehensive income of $369,500. Now, we have accumulated other comprehensive loss as of the beginning of 2028 of $61,000 $940. We add that other comprehensive income of $23,812. I'm sorry, we subtract that other comprehensive income, and that gives us an accumulated other comprehensive loss of, at the end of 2028, of $38,128. Okay. Now, the accumulated other comprehensive loss is reported in stockholders' equity section of the balance sheet. So here, as shown, we have our usual common stock and retained earnings, but now we have that accumulated other comprehensive loss shown here at $38,128 for a total stockholders' equity. So, a summary of these pension plan disclosures. Here is a schedule that shows all the major components of pension expense. I'll let you read that rationale on your own. And then number 2, reconciliation, showing how the projected benefit obligation and the fair value of the plan assets changed from the beginning to the end of the period. And again, I'll let you read on your own the rationale for reconciliation. Number 3, the disclosure of rates used in measuring the benefit amounts. That's the discount rate, the expected return on plan assets, rate of compensation. And again, I'll let you read the rationale on your own. Number 4, we have a table indicating the allocation of pension plan assets by category. And that includes equity securities, debt securities, real estate and other assets, and showing the percentage of fair value to total plan assets. In addition, a company must include a narrative description of investment policies and strategies, including the target allocation percentage if used by the company. Again, I'll let you read that rationale on your own. Number 5, expected benefit payments. Those are those to be paid in the current plan participants for each of the next 5 fiscal years and in the aggregate for the 5 fiscal years thereafter. Also required is disclosure of the company's best estimate of expected contributions to be paid to the plan during the next year. Number 6, nature and amount of changes in plan assets and benefit obligations recognized in net income and in other comprehensive income of each period. And then finally, number 7, accumulated amount of changes in plan assets and benefit obligations that have been recognized in other comprehensive income. Okay. Now, if we look at the minimum note disclosure of pension plan for the Zorro Company, here is an illustration. Under note delta here, the company has a pension plan covering substantially all of its employees. The plan is non-contributory and provided pension benefits that are based on the employee's compensation during the 3 years immediately preceding retirement. The pension plan's assets consist of cash, stocks, and bonds. The company's funding policy is consistent with the relevant government, ERISA, and tax regulations. Pension expense for 2028 is comprised of the following components of pension cost. Here we have service cost of $16,000, interest on projected benefit obligation of $26,500, the expected return on planned assets, $15,960 negative, and amortization of prior service cost, $17,600, and finally, amortization of net loss of $172 for a combined total pension expense of $44,312. Now, other changes in plan assets and benefit obligations recognized in other comprehensive income. Here we have our net actuarial gain, $6,212. We have amortization of prior service cost, $17,600, for a total recognized and other comprehensive income of a negative $23,812. So the total recognized in pension expense and comprehensive income, therefore, is $20,500. Okay, and we have a non-current liability here, pension liability of $98,900. The amounts recognized in accumulated other comprehensive income related to pensions consist of net actuarial loss of $23,728, prior service cost of $14,400, giving us a total of $38,128. All right, so now we have a change in benefit obligation shown here. We start with the beginning benefit obligation. We add the service cost. We add the interest expense. We didn't have any amendments or prior service cost or actuarial gain. And we paid out some benefits of $18,000. So our benefit obligation at the end of the year was $289,500. The change in the plan assets, we're going to start with the fair value of the plan assets at the beginning of the year, the actual return on plan assets during the year, contributions during the year, and of course our benefits paid of $18,000. And that gives us a fair value of plan assets at the end of the year of $190,600, which we can then subtract from the benefit obligation at the end of the year to have our funding status, which is a liability of $98,900. And here we're going to the weighted average discount rate used in determining the projected benefit obligation was 10%. The rate of increase in future compensation levels used in computing the 2028 projected benefit obligation was 4.5%. The weighted average expected long-term rate of return on the plan assets was 10%. Okay, those are rates used to estimate plan elements. So finally, we take a look at a summary of the expense components. We have the service cost, interest cost, expected return on plan assets, amortization of prior service cost, amortization loss, and finally the total pension expense. And we'll note that the expected return must be disclosed not on the actual return. In 2027, the expected return is $13,410, which is the actual gain, $12,000, adjusted by the unrecognized loss, $1,410. And then in 2028, the expected return is $15,960, which is the actual gain of $22,000, adjusted by the unrecognized gain of $6,040. That looks like a good place to stop this video. And when we return, we'll take a look at the reconciliation for Zorro Company. Until that time, bye for